Sean Howard here from Mortgage Architects. A question that we get a lot in our office is what is your best rate? Happens almost daily. And when we try to answer that, I almost get the feeling that our clients are like, oh, here we go. Here we go with the sales pitch, right? Because you can't answer what your best rate is. But it's a legitimate, delay in giving you the answer. It's legitimate for us to ask for a little bit more information, because it's almost like walking into a grocery store and saying, what's your best price? It depends on what you're buying, right? So when it comes to mortgage rates, what you'll see on the internet inevitably is the best case scenario. And the best case scenario in terms of rates is you have excellent credit and you're buying in the perfect location and you have lots of income and it's all guaranteed and salaried. That's not mandatory, but you have good income to support it and good history. And you're putting 5% down, you're purchasing a home. Okay, let's say less than 20% down and you're purchasing a home. Okay. If you check all of those boxes, then that's going to get you amazing rates. Like those are the ones that you see on the internet all the time. But it's not until you call the broker or the bank and you give them a little bit more information that they say, oh yeah, that rate doesn't apply to you. And again, it could be for many reasons. It could be that your credit isn't quite high enough and you don't qualify for it. Or you're putting too much of a down payment on your home. You don't qualify for it. Like if you put more than 20% down, then you're not going to qualify for it. And it seems counterintuitive. Why would the bank penalize you on rates for putting too much of a down payment on the purchase of a home? And the reason why is it comes down to risk. It always comes down to risk when it comes to how expensive a mortgage is. Okay. So in the case when you put less than 20% down and you're in that, what we call it, a high ratio mortgage, you're in that category where you qualify for the amazing rates. Yeah, you qualify for amazing rates. But the catch is that you're also paying for CMHC. You may be familiar with them, or there are other companies there as well, Genworth and Canada Guarantee. You're paying a massive amount in government insurance. And the reason why is because if you put less than 20% down, the bank is mandated to involve the government agency. Again, CMHC is the most common one that people hear thrown around. You're paying, like, let's say $15,000, it depends on the price of the home, of course, but you're paying a considerable amount of money in an insurance premium, and they're just taking that and they're tacking it onto the top of the mortgage. And you're paying for that over the next 25 years. Okay. So, what does that mean? Well, that means, yeah, you get amazing rates and you're going to save on that side, but you're going to end up paying way more in the long run. So, I mean, putting less than 20% down should be only out of necessity. And it's actually better to avoid that insurance premium and pay the slightly higher rate than it is to pay the insurance premium and get that amazing rate that they're advertising online. Okay. Now, there is another category that also can get you that amazing rate, and it all comes down to risk again. It's if your down payment is large enough. So if your down payment is small, meaning less than 20% down, great rates. If your payment is more than 35% down, then you've reached another threshold where you have great rates. It's the in between where the rates aren't as good, or if you're refinancing your home. Okay. But the point is, those rates that you see online are the absolute best case scenario. Okay. And usually it involves paying an insurance premium. Okay. So again, when we're asked the question, what's your best rate? We can just jump to the perfect scenario. Perfect meaning maybe not great for you because you end up paying an insurance premium. But really, we need to look at a few different factors. What are you doing? Are you refinancing your home? Rates aren't as great. Are you purchasing a home? Yeah, okay. We might be able to get you an excellent rate, or it might be a little bit higher depending on your down payment and your credit and your income. Okay. If you can't afford the mortgage and we need to go to alternative lenders, then the rate's not going to be as good. If your credit isn't great, the rates aren't going to be as good. So it goes up from there. Right now, it's April 2020, and in terms of high ratio rates, so, or if you're putting that massive down payment on the property, you're looking at mid twos. You can see like 2.5 plus or minus. And if you're talking about a refinance, then it's closer to 3%. And then if we have to go to alternative lenders, it goes up from there. So, 4%, 5%. And then if it becomes, a private lender, then it gets upwards of, 7, 8, 9%. And then worst case scenario is you can't get a mortgage anywhere, and we have to put you into a private mortgage temporarily, which I have done to get people into their house. And I've done a purchase on a private mortgage before. And we really try to make it short term because it's expensive. It can go upwards of 10 and higher. So I hope that kind of gives you the lay of the land in terms of purchasing a home.